on Business Incorporated today. Kenyan manufacturers feel the impacts of Russian invasion. Egypt looks at raising price of loaves. And Nigeria to supply gas to Equatorial Guinea. Hello and welcome to the program. This is Business Incorporated on Channels Television. I'm Ini John Mekwa. Well, we kick off the midweek show with market numbers where almost all markets we track in Africa are mostly in the red at intraday here on the African continent. Nigeria's main index is marginally down 0.25%, and that was at intraday, while South Africa's GSE was up 0.52%. Elsewhere on the continent, the EJX30 shaved off 0.68%, and Kenya closed Tuesday's session positive. It was up 0.12%. Over in the Middle East, investor sentiments were mostly positive at intraday. That's the flip side. Dubai's index gained the most. It jumped by 2.06%. Meanwhile, the Abu Dhabi index gained 1.67%. And still within the region, the Qatari index was up. It was in the green, 1.20%, while the market in Saudi Arabia rose marginally, 0.05%. Well, let's go to Europe now as the fighting in Ukraine intensifies. We have no choice but to look again at the economic impact this is having on Europe. Chris Cobb joins us with details from Berlin. Well, Chris, with prices for oil and gas surging amidst this conflict, the United States and other major governments have agreed to release oil supplies from strategic stockpiles. Has this move calmed the market in any way?
It doesn't look like it. Crude surged past $110 a barrel on Wednesday, with investors growing increasingly fearful about the Ukraine war's impact on global energy prices. Russia is the world's third biggest oil producer. We have to keep that in mind. Now, in his State of the Union address, President Joe Biden said the United States would join a 30-country deal to release 60 million barrels to help temper the surge in prices. However, analysts had indicated that such moves would likely only have a limited impact, and indeed, that is the picture we are seeing at the moment. Many eyes are now on what OPEC and other major producers decide at their meeting today. The oil price surge has compounded fears about inflation as it sits at a 40-year high in the United States and at record highs in the Eurozone as well. And indeed, inflation in Germany rose again in February to 5.1%. Now, with prices for commodities rising and an end to the armed conflict between Russia and Ukraine far from likely, stock prices had been coming under pressure on Tuesday, and it is a similar picture today. Germany's blue chips index DAX losing around 1.5% in the early parts of the trading session.
About the United States, the U.S. is hoping to sell more LNG to Germany as the country aims to diversify its supply of fossil fuels. Do you think that will happen?
Not according to what Robert Habeck, Germany's vice chancellor, has been saying on his trip to Washington. There he pointed out that Germany aims to diversify its supply of natural gas. Until now, around 55% of it stems from Russia. And he said that Germany wants to import more liquefied natural gas, LNG, through to ports that still need to be built. Now, that is the business prospect that the U.S. had been banking on, not just under the current administration, but already under the previous one. However, Robert Habeck said that Germany aims to import its LNG mainly from Qatar and not the United States. Qatar is leading the world in the production of LNG. And even before Habeck's visit to Washington, experts here in Germany have been saying that gas imports from the U.S. alone would not be enough to supply the whole of Europe. So Qatar could soon become a partner of growing strategic importance. Also, Robert Habeck said that Germany is prepared should Russia's President Putin decide to use energy supplies as a weapon and cut gas deliveries. There are reserves that Germany can tap into, and in a worst-case scenario, the country could extend running its coal power plants, which the government initially wanted to phase out in the coming years in order to achieve climate goals.
Well, a lot of things going on there. Now, the Western economic sanctions are having a growing impact on the lives of the people in Russia. What does it look like, really?
Well, sanctions against the Russian economy and against some of the country's biggest banks in particular have been worrying people. We have seen the pictures of long lines in front of cash machines. Russians are trying to withdraw money from their bank accounts as the value of the ruble has been deteriorating. And the concerns appear to be justified because Russian residents, by decree of the Kremlin, are no longer allowed to leave the country with more than the equivalent of $10,000. That's certainly a signal that the Kremlin tries to keep capital inside the country. The rule affects movement of foreign currency as well and seems designed to make sure that people attempting to leave Russia, as sanctions are slapped on the country, don't take all of their hard currency with them. Now, as I mentioned, long queues are now common at cash machines that still have banknotes as people try to withdraw their holdings against the backdrop of a ruble that is rapidly losing most of its value. Prices of imported goods are shooting up, and people are trying to purchase some items like new phones before they become unaffordable.
Thank you so much for that update, and enjoy the rest of your day. Well, certainly things are very far from normal at this time, from the surging oil prices to energy and the spilling effects of economic sanctions we just talked about there. And we have Juliana now to tell us the perspective of the UK, what's going on there. Hello, Juliana. Good afternoon.
Good afternoon, Innie.
So now the UK is talking about sanctions for Belarusian army chiefs. Tell us about that.
Well, yeah, the Belarusian military, they stand accused of aiding and abetting Putin and his war against Ukraine. In fact, I think it was about 2 weeks before last week's invasion that Moscow deployed troops under the guise of military drills to the Belarusian border, and they've been able to invade Ukraine from the north. Britain, via the Foreign Secretary Liz Truss, has vowed to sanction anybody that has close links to Putin, which is why we have seen these sanctions against 6 individuals in Belarus overnight. This is the chief of General Staff. There are 3 deputy defence ministers and also 2 military enterprises. I believe they're involved in manufacturing and construction. So they will no longer be able to travel to the UK, or anybody employed under those 2 individual enterprises. And of course, all of their UK-based assets will be seized. This comes just a week after Boris Johnson and the Conservative government imposed the most severe sanctions that any British government have imposed on another nation. Currently, Prime Minister Boris Johnson is speaking to British MPs in the Palace of Westminster during PMQs. This is the first Prime Minister's questions we've had since that invasion. There was a raucous round of applause for the Ukrainian ambassador, who's currently in the chambers listening to exactly what Britain will do. I believe over 250 Russian oligarchs have been sanctioned. However, there was some pretty tough questions from Sir Keir Starmer, the Labour opposition leader, asking why particular individuals haven't yet received the full scale of these sanctions, including Roman Abramovich, the popular owner of Chelsea Football Club, and other individuals that we know have very close ties with Boris Johnson's government. Boris Johnson's government have received substantial amounts of money and donations from wealthy Russians living in the UK. But I think the government were very quick to bat those accusations off. They want to show a united front, and they do believe that they've gone far enough. Perhaps they could go further. But yes, Belarus, the latest to receive the raft of those sanctions.
Juliana, a whole lot of factors to consider there we see for Boris Johnson in the area of the sanctions. But natural gas prices spiked about 40%. What effect is that having at this time?
Well, it's having a major effect. I think yesterday the wholesale gas price was 6 times higher than it was last year. And of course, we know last year gas prices were so high because of the ease in restrictions and the demand for natural gas, particularly from China. I think in one way, Britain is quite fortunate. Unlike the rest of mainland Europe, that I believe they are heavily dependent upon Russian gas. We're not. We've got our own natural gas up in the north of the country, but that doesn't mean the wholesale market doesn't affect us. So it is causing significant fears. We have heard from Gazprom, which is the largest state backed a gas firm in Russia, that they are at the moment still supplying gas to Europe via Ukraine. And it seems to be going seamlessly at the moment, although there are, of course, serious fears, which is why the gas price is so high today, because, of course, we know that tap can be turned off at any moment. There are severe sanctions that have been imposed by the West onto Russia. When is Russia going to retaliate? That is the fear. And we know the biggest way it can retaliate is to turn off that gas pipe. That's not happened at the moment, but there are still fears, which is why gas prices are surging. Again, we know this is obviously going to lead to higher energy bills, which is coming in April. But so far, Britain is shielded. But nevertheless, the markets are still tense at the moment.
And how is the market reacting to all of this development at this time?
Well, for the first time this week, we are seeing that the FTSE stock market is rallying. The all-share is actually up. It's doing much better than what we're seeing in Europe. It's up by 0.70%. The FTSE 100, the blue chip index, is up by 0.73%. And the domestic market, the FTSE 250, that's up by 1.1%, 1.16% rather. In the currencies market, the British pound is currently down on the US dollar by 0.10%, though up on the euro by 0.20%. And up on the Japanese yen by 0.25%. No surprises in that because of the rally on Brent crude oil, both BP and Shell, their share price is up by between 1.5 and 2.5% today.
Yeah, you can see that again because it's spilling even to the US. Well, thank you so much, Juliana. Enjoy the rest of your day. So our stock features slipped earlier at intraday as oil prices continue to surge amidst the ongoing conflict. But later on, it picked up as we see that the futures tied to the Dow Jones Industrial Average was up over 0.5%. S&P 500 and NASDAQ 100 futures also followed the positive sentiment, 0.53% and 0.68% respectively. In regular trading, the Dow fell 597 points, while the S&P 500 lost 1.55% and NASDAQ Composite slid 1.59%. We have details of yesterday's trading from our correspondent, Maria Bird in Washington.
The U.S. stock market fell sharply on Thursday, a bleak start to the month of March, as the S&P 500 was down 1.55%, the Dow Jones down by 1.77%, and the NASDAQ dropped to 1.59%. It is clear that the Russia-Ukraine war is having an impact on the U.S. economy, but investors are also weighing what will happen next with the Federal Reserve Bank. Will we see interest rate hikes as soon as this month?
Let's go to Asia now. Shares in Asia Pacific mostly tumbled as the ongoing Russia-Ukraine conflict continued to lead a surge in oil prices. The Nikkei 225 in Japan dropped 1.68% to close at over 26,000, while the Topix index shared almost 2% to 1,859.94. Hong Kong's Hang Seng index shared 1.85% as of its final hour of trading. Mainland Chinese stocks also finished the trading day in the negative territory, with the Shanghai Composite down 0.13% to 3,484.19, while the Shenzhen components declined 1.05% to over 13,000. Meanwhile, South Korea's Kospi closed 0.16% higher. Elsewhere, Australia's S&P AX 200 rose 0.28% to close at over 7,000 on the back of positive economic data. Economic activity in Australia rose 3.4% in the fourth quarter from the third. MCSI's Broadex Index of Asia-Pacific shares outside Japan shared 0.86%. We'll take a break now. When we come back, we have stories for you from the African continent. To stay with us is Business Incorporated on Channels Television. You're welcome back. You're still watching Business Incorporated on Channels Television. Well, Kenya is the net importer of wheat, maize, and fuel from Ukraine and Russia. In 2020, Kenya exported goods and services worth over 8 million Kenyan shillings to Russia. Global wheat prices have gone up from $345 per ton to $460 per ton over the last few days. Well, Kenya relies on both Ukraine and Russia for wheat in the second half of the year because other regions such as Argentina and Australia harvest in December. This means that Kenya will most likely feel the economic hit as a net importer if the crisis persists. Well, we have the head of policy at Kenya Association of Manufacturers for Research and Advocacy, Job Wajohi, joining us from Nairobi to give us up to date and what are their plans. Hello, Job. Good afternoon.
Good afternoon. How are you?
Great. So it's about a week now since the crisis started. Has it affected the price of wheat and some other commodities that you import from both Ukraine and Russia?
Yeah, indeed, I have to note that the crisis is a tall order on our importation bill because as manufacturers, we normally import about 80% of some of these raw materials from Russia and Ukraine. When you're talking of the wheat, sometimes the barley, the corn, you find that we import in high intensity. The challenge at the moment is that in the last 1 or 2 weeks, we have seen an escalation of the price. As you mentioned, we have seen per ton increasing from $345 about 460, and we foresee a situation where we are likely to get to 500 per ton. And for the landed costs in Nairobi, about 550. This will have serious ramification on the household items like now the bread. When we talk of anything that is made of wheat. So already because whatever we have imported is coming at around $460 per ton is at a now production. The products thereof, the finished products thereof, are the one which are going to hit the shelf with a higher price. So it's a tall order on the not only on the manufacturing sector in Kenya, but also on the retail sector and also on the household.
Yeah, it would be nice to know how easy it is for manufacturers to pass on this price to the consumers because, I mean, at the end of the day, the consumers pay for it.
Generally, as a manufacturing hub, because we're operating at a globalized system, we try as much as possible to operate at the low margins so that we are price competitive. So there is only this extent that we can increase the price at. At the same time, there's this margin, probably 4% or 3% that we can retain as manufacturers, so that we remain afloat. So it's a question of trying to balance between the margins that the manufacturers can make and the low that they can go as far as the margins are concerned before a decision is made of passing over the extra cost to the end consumer. At the moment, we are advising the manufacturers to try as much as possible not to decrease the price because there are various other externalities that we're facing at the moment. Like now, the exchange rate between the hard currencies and Kenya shilling is highly affected. We're talking about the oil, the fuel. US dollar per barrel is $100 US going forward. So we don't want to compound the problem further for Kenyans. So we're asking the manufacturers and also other players along the supply chain and the value chain to try and restrain themselves to certain margins so that we don't offload too much burden to the Kenyans. At the same time, this can lead to inflation. It can lead to lower standards of living and high cost of living.
So as manufacturers, are you exploring other sources? I mean, if this crisis persists, that means your supply from Ukraine and Russia may just be closed. So are you already exploring other sources of supply?
Of course, yes. You have already mentioned that like now Argentina and Australia, the harvest comes in December.
In December, yeah.
So harvest is in the high seas. We are raising costs to them. Whatever they are holding back as their buffer stock, they can offload. We have seen a country like Algeria promising the European countries that they're going to send more gas to Europe if at all the gas supply from Russia is to be cut. Subsequently, is the same ask that you're having now to our traditional suppliers from Australia, from Argentina, to increase the much that they offload to the country. Besides that, we have other short-term measures that we're exploring within the country. There is local production of the wheat that happens. About 60% we depend on wheat that is locally produced. So we are really getting to our farmers as much as possible and promising them better prices so that the wheat is not exported outside the country, but is meant for local production. So those are some of the measures that we're taking into place. But again, when we have such a crisis, it exposes to various value chain gaps. For instance, when we have 66% local sourcing of the wheat, why are we not doing at 90% or 95%? So there is a call to the government to ensure that in a medium term and also in long term, we are ramping up production or wheat farming in the country so that we are not disrupted by the externalities or by the global issues that might come up now and then.
Yeah, well, who knows, Joe? This might just be one motivation to look inwards, and you'll be surprised that you can actually provide for yourself at the end of the day. Well, thank you so much, Joe Mwajohi, Head of Policy at Kenya Association of Manufacturers. Thank you for bringing us up to date on that.
Thank you so much.
Moving on now, in Egypt, there might be a rising of the price of subsidized loaves for the first time in 4 decades, and it's all because of what's going on in Ukraine. Egypt's already struggling to maintain the subsidy used by about 70 million people in the face of a pandemic, and war could make things worse. Current wheat stocks are sufficient to last for about 4 months, but shipments from much of the Black Sea region are stalled by the conflict and likely pushing prices even higher. Russia and Ukraine delivered 86% of Egypt's wheat imports in 2020, and the combination of the combat, fast-moving sanctions announcement, and surging freight and insurance costs is propelling the grain to its highest price in more than a decade. In Uganda now, the high cost of essential household commodities are worrying members of the parliament, and they are asking the government to take action and stop rising prices. Concerns of high fuel prices have now shifted to increased prices of soap, detergents, sugar, among other household commodities. A bar of soap has increased to about 9,000 shillings, with sugar surpassing its normal market price. And finally, the government of Zambia, in partnership with the European Union and the Common Market for Eastern and Southern Africa, COMESA, has launched a 6.8 million euros project to upgrade Zambian border post. The project, Zambia Border Post Upgrade Project, whose implementation has been underway since the signing of the financing agreement in November 2020, aims at improving intra-regional trade flows of goods, persons, and services. That's it on the program for today. Thank you so much for being a part of it. I'm Ini John Mekwa. Don't forget to join us tomorrow for another episode of the program. Thank you for watching.